Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to talk about the instant 20% return when you do this. And so we're just going to get right into it. So if you're new to the channel, welcome. This is where you put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. But of course, sometimes we just don't show the portfolio. We do that at least once a week. Yeah, let's talk about this 20% return. But how's that possible, right? The market typically doesn't return that much. Average over 100 years, it doesn't return that much. 7% is what everyone uses, or 8%. But let's talk about a 20% return. And I guess I've been harping a little bit about this and just your finances in general, not just the stock market, not just investing. There's a way you can get an instant 20% return. And it's this thing that is called a credit card. People like to use this thing to collect points and so on and so forth. And there's maybe not a talk or a topic around it because some people have immense credit card debt and just can't seem to get out of it. And even though they have credit card debt, they're investing. And I'm going to explain why it's an instant 20% return. And we're going to use 20%. And I know there are higher interest rates, but 20% return. So this is great for Visa, for MasterCard. They're getting 19.99 or 20.99 or 23.99% on you spending and not paying that thing off. And imagine the return on that. Imagine that you could have a 20% return every single year for yourself. Okay. That'd be amazing. Everyone would be multi-millionaires. But that's just not the case. And so we live in North America. I live in Canada. There's probably people that live in the United States, but credit cards are everywhere, all around the world. And typically it's Visa or MasterCard, very well known. American Express is a known one as well. But Visa, MasterCard, let's talk about the big two, and what that means for you. So if you have a credit card that's 20.99%, and let's, I know there's a grace period on interest for, I think, 21 days or 23 days on a credit card if you pay in full. But some people like to make the minimum payment. And there's myths out there that talk about, oh, if you keep a balance on there, it's good for your credit. But in my opinion, why would you do that? Why would you pay a 20.99% interest on building your credit? That just doesn't make sense to me. And so let's say your credit card is $1,000 and you have it maxed out. And we do simple math, 20%. Let's just use that number. That's $200 per year that you pay in interest. And what does that mean, pay in interest? That means you are paying them a profit or a risk premium for you to hold that $1,000 debt. And they make 20% for giving you $1,000. Anybody in their right mind who would see a 20% return on a stock, a strong, good, fundamentally operating company, would be investing in that company and only that company if they were doing a 20% return every single year. And so let's say you make, if it's costing you $200 to hold $1,000 debt and you pay off that $1,000, you yourself have literally given yourself a $200 raise for the year. That's amazing. That's great. And so that's it. That's all you have to do is literally pay off your debt. I know we live in America and North America, and we have this consumer mentality when we want to buy something that we think we need, but in actuality, maybe we don't need, and we don't have the money for it. It's easy to have instant access to a credit card and use that to collect points and so on and so forth. And the points thing I get. If you're with RBC, they have the WestJet MasterCard, or you have some sort of points thing, okay? And you use your credit card to get the points. Is the return on points? Really try and do the math on this stuff. Sometimes the return on points is not worth having the debt on there to get a free trip. Not even a free trip, because the thing is with points, just so you know, is that when you use these flight points, it doesn't cover taxes. So you still end up paying a sales tax on a $2,000 ticket to the other side of the world. I've experienced this. I get it. I know it. You spend $2,200 on a ticket and there's like $300 in taxes that you got to pay. That's not a free ticket. You still have to pay. Yes, it's better than paying $2,000 and so on and so forth, but you have to spend an exorbitant amount of money just to get a ticket cost covered. And some people are like, oh, but that's why you do tuning. But believe it or not, I don't think that's going to be happening longer and longer. Trust me, Visa and MasterCard are smarter than the average person, I think. And they're great perks. If you can do it in a good way, in a smart way, in a mature, controlled way, then sure, do that. But if you are living paycheck to paycheck, not putting money away, and you're struggling with debt, handle the debt. Because if you have a 7% loan on a vehicle, 8% loan over here, a 9% line of credit, a 20% credit card, you need to pay those things off because the market will not return enough to cover the interest on those things. And yes, there are things like leverage trading or margin accounts and things like that, but you really have to be risk adverse to want to do those things. I don't even do it personally. It's just not a risk I'm willing to take on. Hence why this is a dividend channel and we talk about those things. Okay, the return is very important. If the return is so important to companies, shouldn't the return on your investment be valuable to you? Shouldn't you pay these things off and just give yourself an instant return of 20%, 7%, 8%, whatever it may be? And I'm also talking about vehicles. I think North America has like the largest amount of vehicle debt around the world. I mean, just think about it. Like when people tend to buy a new vehicle before they buy a house, and banks or lending companies like to look at what you have for cash flow. And if everything's being eaten up by payments, they're not going to be very accommodating when you're trying to get a mortgage or when you're trying to make a big purchase. And a mortgage for most people is their biggest purchase in their life. They're going to look at what your cash flow is. And if you don't have cash flow because you're paying interest, chances are you're probably not going to get a mortgage. Here's the thing. Every investor loves cash flow. They love free cash flow. That's what I like to think, in my opinion. For me anyways, I love free cash flow. I love cash flow. And also other companies like cash flow. If you yourself do not have cash flow and you're running a deficit, which means you're running negative or going backwards in your finances every single month, take a good look at where your money is going and start cutting expenses or paying down debts and giving yourself that instant return. If you are investing and you have a 20% credit card with debt on it and you're not paying it off every single month, you should probably, not financial advice, in my opinion, I would pay off the debt first and then start investing. And so that's pretty much it. So give yourself that instant 20% return. Pay off that credit card, pay off any debts that you might have, and start investing, start putting money away, start preparing for whatever is coming down that pipeline in the next 6 months, in the next year. This is probably the time to do it because we don't know what's going to happen. There's a lot going on in the world, and it might just be a distraction. But focus on what you can control, and that is your debt. So take care of it. Hopefully you guys found some value in this video. Don't forget to leave a like and subscribe, and we'll see you guys in the next one. Bye.